sometimes called a phantom expense, because it only exists on paper. And what it does is it reduces your taxable rental income, often creating a loss for tax purposes,
Mm-hmm.
despite the fact that the property might be generating positive cash flow. So,
Right.
in other words, you're putting money in your pocket, but you're telling the IRS, hey, I lost the money. So
Right.
now this rental income it could be taxed at that same rate up to 37%. Because of this non-cash expense called depreciation, you're actually not paying taxes on this income.
Are you frustrated watching your hard earned money ride the knee jerking Wall Street roller coaster? Are you looking to diversify into alternate investments and set them on autopilot to achieve financial freedom? It's time to learn the ways of the wealthy. It's time to think outside the stocks with your host, Madhvi Jain, an immigrant from India and ex-IT professional who will bring you industry experts to illustrate a passive and holistic financial approach to build not just passive income, but also your generational wealth. Madhvi is on a mission to change the financial trajectory of one family at a time and 1,000 more to go. Are you going to be part of this vision? And now, without further ado, here is the host of Think Outside the Stocks, Madhvi Jain.
Hey, welcome back to Think Outside the Stocks. I am your host, Madhvi Jain, and I have here with me a CPA. Yes, a CPA, Thomas Castelli from Hall CPA. But before we go ahead, I do want to mention that this is information and education purpose only. Whatever we are providing as an education on this podcast, please be sure to do your own due diligence on it. Consult your tax professionals, your lawyers, so that you can implement this strategy in your financial structure. Welcome, Tom, to the Think Outside the Stocks podcast.
Hey, thank you for having me. It's an honor to be here today.
Thank you so much. And listeners, if you have a question that if you are investing into real estate, does that passive loss actually help you as a W-2 earner or an active income earner in some other category? So we are going to delve much into that today, that how can you actually benefit from these passive losses the real estate syndications are bringing to you. So I'm excited about that conversation, Thomas, with you. So let's jump into it. But before we go there, I do want to always welcome my guests with 3 interesting facts. So here are 3 interesting facts about Thomas. Number one, like many of us, he is also inspired by the book of the nation, Rich Dad Poor Dad. Yes, even a CPA could get that inspiration and change the direction a little bit to make that humongous leap. So Thomas, it's great to hear about that. Number two, that he is not only a CPA, but he is also a real estate investor himself, an active and passive. And that's why it's really important to know from his perspective how actually those passive losses can be implemented if you have this, humongous active income in something completely different, like a CPA field. So that's fact number two. And fact number three, Thomas just was mentioning that he loves kickboxing. That's amazing. There's so many different sports that we kind of bring our life balance to, but kickboxing, it's quite interesting. Thomas, quite honestly, I tried it myself, but I found that very difficult. So we'd love to know more about that. So with that, let's jump right in, but let's begin with a little bit about your story. Do you mind telling our audience, introducing yourself, why you are doing what you're doing, and how did you get here?
Yeah, absolutely. So my name is Thomas Castelli. I'm a CPA, and I help real estate investors reduce taxes. And I work with real estate investors of all types, passive investors, active investors, and everything in between. And kind of how I got here was when I was going to school. I went to school for accounting, and I realized somewhere along that college path that going and getting a job alone was not going to be able to get me to where I ultimately wanted to go in life. So I picked up books like the Rich Dad Poor Dad book, and kind of found that real estate was a common theme amongst people who built wealth. So I decided to start going to monthly networking events and meetups and what have you, and eventually met a group of people who were doing a 3-day weekend on real estate syndication.
Mm-hmm.
So I went to that 3-day weekend and I learned everything about real estate syndication, fell in love with that business model, started going to their monthly events, and eventually investing with members as a limited partner. So as a limited partner, I was actually able to see some of the behind the scenes stuff and kind of learn the ropes a little bit. And the group that I was working with at the time said, hey, look, if you find a deal, we'll syndicate that deal with you.
Right.
So started building broker relationships, and sooner or later deals started to come my way. And one of those deals penciled out, brought it to the team, and we ended up syndicating it. So that was 82 units in Jacksonville, Florida. That since went full cycle. So that's just a little bit about me. And around that same time, I actually met Brandon Hall, the founder of Hall CPA. And I said, hey, I'm about to start either my own firm, or I'm about to go and find a search so I can go and do taxes for real estate investors, kind of marry the two together. And long story short, took a job at Hall CPA. Now I'm a partner and get the privilege of helping a lot of different real estate investors reduce taxes. So it's a great place to end up.
That's amazing. Thank you so much for sharing that story. Congratulations, first of all, for that first full cycle deal and being active. And one thing, I learned from your story, from my story, from everyone else's story, that, there is fun in carving your own path, but there is actually, you don't have to reinvent that wheel. So
Right.
it's always good to leverage other people's expertise. And, it's great that you actually got to do that active deal, and which is humongous work, by the way. Good to know that whatever it takes to complete that deal. But listeners, if you are listening to this, you don't have to reinvent the wheel. If you want to go into something active, test the waters, being passive first, and test the waters, ask all the questions, learn everything that you need to educate yourself, and then jump in, which, Thomas, looks like you also did. So that's incredible. And congratulations on the path to Hall CPA as well. Great firm. We have, in this our small network of real estate investors, there is a lot of reputation and there is a lot of education, membership that you actually provide, which help passive investors tremendously. And you were mentioning how you help investors, which, have probably one investment to hundreds of investment, right? So let's talk about that. And people actually think that tax filing is a job, but tax planning and tax strategy, it's highly important. So let's talk about the tax strategies portion of it. Why is tax strategy so important, and how can passive investor leverage that expertise from somebody like you?
Yeah, absolutely. So let's start off like this. I think the best way to kind of break it down is like this. So when you have your tax return every year, that's going to get filed. If you made money, chances are you have to file the return. And a tax preparer simply takes the information you provide them, puts it on the form, and makes sure everything is filed in compliance with the IRS standards, the tax code, and all that, and then ships it off, right? So they prepare your taxes, and that's it. That's their job. And most tax preparers are so busy doing that they don't have time to ever provide advice to their clients, right? So the tax return, again, the tax return is like a report card of the income and expenses and the activities you did from the prior year. Whereas tax strategy and tax planning is looking at your facts and circumstances. So what you have going on today, where you're looking to go. So what are your future plans, and saying, okay, well, based on where you are today, where you're looking to go, here's the moves you can make, here's the things you can implement, so that when it comes time to file your tax return, you're putting yourself in a very favorable position. So I guess to summarize that, a tax return is just reporting what happened the prior year, kind of like a report card. Here's how you did, right? Whereas tax strategy and planning is actually influencing what that report card is going to say. In many cases, you're going to need to do that before it comes time to file that tax return. For the most part, once it comes time to file your tax return, that year, the prior year, is already closed. It's like 2023, for example, it's over. You can't go back and do much else. So tax strategy and planning is important to making sure that when you file your tax return, you're minimizing your taxes.
I love that. I love the report card analogy. Thank you so much for that. So given that, what's a great time to start doing that tax planning?
And that's a great question. Really, as soon as possible. I mean, in an ideal world, you're doing tax planning in the beginning of 2024, right? You're doing it in January, perhaps February, and then that's going to help set the tone and give you what you need to go ahead and execute during the rest of the year, so that when it comes time to file your 2024 returns in 2025, you're in good shape. Having said that, we've seen success with people starting at any point throughout the year. So really, the sooner you get started, the better. and the more runway you're going to have in terms of what you can execute.
Right. Yeah, I always talk to my investors, especially when it comes to investing, that you should have the end goal in mind, right? So once you
Right.
have the end goal, you almost kind of reverse engineer and carve your path, that okay, this is where I want to be. So if you have that goal in mind, that okay, if I don't do anything, this is going to be my tax liability, and kind of
Yeah.
reverse engineer that how I can diminish that tax
Right.
liability, right? I think that looks like it. So given that, let's jump into our topic for today to understand that passive investor implication of taxes, and how can actually the commercial real estate project, syndicated project, can help them with their tax liability. And typically, at least I kind of look at that, if there is some dollar amount being added to their income with cash flow or any kind of returns, at least that becomes efficient, right?
Right.
At least that becomes tax smart, right? So
Yeah.
let's talk about, and I can literally throw in bunch of words here, and people who have not heard about it yet, that could just sound like jargon if I start talking about cost segregation or bonus
Yeah.
depreciation and things like that. But it's a good time to actually take a minute, talk about it, kind of decipher for them. So can we talk a little bit more about how the tax benefit in commercial real estate works in a very, very simplified language?
Yeah. So I'm going to break it down like this. So for passive investors, limited partners who invest in syndicates and funds like me, I'm in the same bucket. There's really two tax benefits you get from doing that. A is the ability to shelter the income that's being generated, or the cash flow
Yeah.
from these syndicates, from tax. And I'll talk a little bit why that's important in a second. And the second thing is the ability to shelter, to use the losses that are generated from these investments to offset passive income from other perhaps passive investments you have, including gains on the sale of another property or another investment. So let me kind of dive into that a little bit and unpack
Sure.
it. So if you have a job, if you have an active business you're running, you're generating active income, they call it, or non-passive income. And this is typically taxed at up to 37% at the federal tax bracket. And then when you add on state taxes and perhaps local taxes, if you live in a city like New York, and then you add the FICA taxes, it's not uncommon to see high income earners paying 40 to 50% of their income in taxes.
Incredible.
And it's painful. It's painful. I see people do it all the time. And so the first benefit is when you invest in a syndicate or a fund, well, the rental income that you're generating from the syndicate or fund, well, that's also taxed at 37%. However, there's this non-cash expense called depreciation, sometimes called a phantom expense, because it only exists on paper. And what it does is it reduces your taxable rental income, often creating a loss for tax purposes, despite the fact that the property might be generating positive cash flow. So
Right.
in other words, you're putting money in your pocket, but you're telling the IRS, hey, I lost the money. So
Right.
now this rental income it could be taxed at that same rate, up to 37%. Because of this non-cash expense called depreciation, you're actually not paying taxes on this income.
Right.
So to give a quick example of this, let's say that you had a property and it generated $10,000 in rental income. Now, let's say you're a fairly good operator, so you're operating at a 45% expense ratio. So that means you would have around $6,500 left in income or cash. Now,
Right.
in most businesses, you'd pay tax on that $6,500 of income. But now let's say you have a $7,000 depreciation expense, which is not at all out of the ballpark. So
Right.
now what happens is you have a loss of $500. So that means you did not pay tax on that $6,500 that you put in your pocket, and now you're telling the IRS, well, I lost $500. So
Right.
that's kind of the example of the first aspect of it, the ability to generate tax-free income from
And
these.
if that's saving you about 40% of taxes, so that's
Right.
significant amount that's saved, right?
Right. That's a big deal. And that's like the first benefit that often gets overlooked. Now, where the confusion or the frustration in some cases comes in is, well, what happens to that $500 loss in this case? And sometimes the losses are much bigger. But what happens to this loss? Well, as a passive investor, this loss cannot offset your W-2 or your active business income. Unfortunately, that doesn't work. We'll get into a little bit, I'm sure, on how you can do that.
Yeah.
But generally speaking, that's not how it works. So a lot of people get frustrated and say, well, if I can't use this loss to offset my W-2 income, well, then what's the point, right? Well, we just kind of went through how you get to shelter your rental income from tax. What ends up happening with this loss, if you can't use it in that year, it gets suspended and carried forward to future years.
Right.
So it doesn't just disappear. Now, it can help you offset future rental income, it could also help you offset the gain on sale of a rental property. So say, for example, you sell one of your syndicate investments is, you're invested in it, they sell it. Now, typically, if it went well, you're going to have a capital gain. So you can actually use passive losses to offset that capital gain on sale. So it's just another way that you can use it.
Yeah, I love that. And we were talking about the rental losses, which is also possible if you are a landlord and if you have a rental property, right? So between the rental property and actually the syndication, the commercial real estate, when they start investing into that, there is kind of a steroid treatment on the taxes, right? So let's talk about that, the cost segregation benefit and how that can actually supercharge their tax savings with the depreciation.
Right. So basically, again, what happens is, like, when you have a rental property, whether you're in a syndicate or you own it yourself, you're going to depreciate that property. Now, with multifamily property, for example, or single family, so residential property, that's typically depreciated over 27 and a half years.
Right.
So that means that if, to kind of just paint a picture with an example, let's just say you had a $500,000 property, just to keep the math easy. Well, land's never depreciated. So part of that $500,000 property has to be allocated to land. So let's say it's 20% allocated to land. Well, that would leave you with $400,000 left. That represents the building. And the building is going to be depreciated over 27 and a half years. So every year you're going to get roughly $14,545 worth of a depreciation expense.
Right.
So that's nothing to laugh at. But here's the thing, right? So the entire building is not just the structural components that are depreciated over 27 and a half years. There's other components in that building. There's going to be things like carpeting, light fixtures. There's going to be pools, decks, sheds, appliances. All of these things are depreciated over a shorter period of time than 27 and a half years. So what a cost segregation study does is it goes into the property. Think of it almost like an inspection of sorts, where an engineer comes down to your property, surveys it, goes back to their office, generates a report and says, okay, well, of your $400,000 building, 20%, for example, just giving examples here, is 5-year property. Another 10% is going to be 15-year property. And the good news is not only can this 5 and 15-year property be depreciated over a much shorter period of time than 27 and a half years, but it's actually eligible for something called bonus depreciation. So if you have property that has a depreciable life of less than 20 years, so for real estate, that's typically that 5 and 15-year property, that can be depreciated in a much faster way. So to kind of paint this picture here, say it's $400,000 property. Well, usually somewhere between 20 and 30% of that building can be reallocated to this 5 and 15-year life. So let's go ahead and take that 25%. That's $100,000. So now this $100,000 is eligible for bonus depreciation. Now, currently, as of this recording in 2024, bonus depreciation is 60%. So what that means is that you're going to be able to take 60% of this $100,000 and depreciate it all in the first year.
Right.
So now, if you take 60% of 100,000, you're going to have a $60,000 depreciation expense, which is quite sizable, and in most cases is going to give you quite a large loss that you're going to tell. You might tell the IRS, we have a loss of $55,000 this year, and what that does is those losses, because they're so substantial, they can help you offset. That's really, for passive investors, this really becomes powerful in a situation where you're selling where perhaps one of your investments is being sold in that year, because now you're going to have this big loss, let's just say $55,000. Well, if you have a capital gain of $75,000, just for example, well, now you're only going to end up paying $20,000 taxes on $20,000 of that capital gain, because that $55,000, long story short, will ultimately offset that gain. So that's cost segregation, that's bonus depreciation, and kind of why it's so powerful.
I love that. And I love that you give that example because, I'm a very numbers person, and listeners, they have a lot of analytical mind too. So the numbers and the examples really, really help a lot. So thank you for elaborating that. So just as a comparison, right? I mean, if you're looking at, and again, listeners, please remember, these are numbers only. These are examples, just point in time. It's not specific any of the situations that you might be going through, right? Every situation is different. But just to give us an idea, Thomas, if, you were explaining about if the rental property property probably, gives 20% depreciation benefit. What do you see the multifamily or the one with the cost segregation and bonus depreciation benefit can give you? And by the way, 60% can be done first year. So where does that rest 40% go? Does that get rolled over to the next year and the next year, or does that basically, get distributed over the rest of the years for that?
Yeah, that's a great question. So that remaining 40% that didn't get bonus depreciated, that will be depreciated over its remaining useful life. So 5 years for that 5-year property, and then 15 years for the land improvements for that 15-year
That
property.
that
Now,
helps.
there's a simple way to look at it is to think just that will be depreciated over 5 and 15 years, just straight line. But there's actually something called the double declining balance, which I'm not going to go into here, which actually accelerates that depreciation towards the front of that 5 year of those class lives. So it doesn't disappear. You'll still get that depreciation. It's just
True.
going to be over a 5 or 15-year period.
Yeah, that helps. And isn't there like a discussion going on to bring down that 100% bonus depreciation back? Because not too long ago, 2 years back, it was 100%.
Right.
Last year got to 80%. This year is 60%. It's kind of declining from there. So do you have any thoughts on, what kind of discussions going on and where would we see it going?
Yes. So basically, you're 100% right. There was 100% bonus depreciation from the tail end of 2017 all the way through the end of 2022. But then it begins to phase out 20% per year. So 80% 2023. Now we're at 60%. However, there's currently a bill that was passed by the House. So it was passed by the House of Representatives. It's now sitting with the Senate, and we're waiting to see if and when the Senate will vote on it. And if the Senate votes on it and they pass it into law in its current form, it'll retroactively bring back 100% bonus depreciation to 2023. So in 2023, it wouldn't be 80%, it'd be 100%, which is great for many people. And then it would also bring it through 100% for 2024 and 2025. And then in 2026, under this bill, if it passes, it would be at 20%. We'll see what happens then and in between then. But long story short is, if this bill is passed by the Senate, which we don't know if and when it will be voted on, you would have 100% bonus depreciation for 2023, 2024, and 2025.
That's excellent. So cross our fingers. Let's see where that goes. Something is better than nothing. Thank you for sharing that. And, going back to my question, I think it just kind of got lost because I asked another question after that. But the question about what is the comparison between the straight line depreciation in a rental property and a commercial? What times do you see that difference? If it is like a 10-20% in rental, how much percent do you see typically in commercial properties?
Yeah. So kind of just two things there. So for residential property, that's depreciated traditionally over 27.5 years. For commercial, it's 39 years, so a little bit longer. Now, as for the actual amount, say 20 to 30%, it really varies on a property by property basis.
Yes.
And you'll see a lot in multifamily compared to, say, single family. You'll see a higher percentage is eligible for bonus because there's a lot more components and stuff that are in there. And when it comes to commercial property, there is something unique about commercial property that differs from residential property. And that's something called qualified improvement property. So qualified improvement property is certain types of renovations, which are actually a large renovations that are done to the interior of a commercial property, fall under this QIP bucket, this qualified improvement property. And that has a depreciable life of 15 years, which means it's eligible for bonus depreciation. So you can see the amounts on commercial properties being much higher depending on the type of commercial property, its size, and to the extent of its interior renovations qualify for this. So that's harder to give a percentage. I mean, I've seen properties go as high as 70% in some cases, and with like car washes, and with certain types of properties like car washes and gas stations, for example, which do kind of fall under that commercial property bucket, up to 100% of that can actually be eligible for bonus depreciation thanks to special carve-outs in the tax law for those specific types of properties.
Yep, that's interesting. Yeah, sometimes I do see at least 2x, 3x, depending on again type of property compared to the rental real estate, just being a landlord and just being a rental house. So that's one of the like I would say the tax benefit on steroids. Now let's go back to our original question about passive investors being able to apply this tax benefit and how can they utilize. I mean, you all already addressed the two portions of it as how they can do it in passive income and their other losses, other gains like a sale from a property, etc. How can they go a step further and be able to apply these losses instead of just rolling it to next year?
Right. Okay. So being able to use it against the non-passive like W-2 and active business income. So there is a way to do it. It is a very thin way to do it. And what I mean by thin is like there's a very fine line. So the way this works is you have to qualify as what's known as a real estate professional. And then there's another step, and I'll explain that as well. So to qualify as a real estate professional, you have to work more than 750 hours. And it's the big one, more than half of your total working time in a real property trade or business.
Right.
So this rule is actually designed for people who work full-time in real estate, why it's called the real estate professional status. So if you have a full-time job, this is going to be nearly impossible to qualify for if your full-time job is outside of real estate and you don't own the real estate company. But extremely challenging to qualify for. It's one of the most litigated areas of the tax code with over 500 tax court cases. And basically, no one with a full-time W-2 job has ever been able to qualify and win an audit, at least to end a tax court case with the IRS. So that's kind of the first thing. Now, the good news is you can have a spouse qualify. So if perhaps you can't qualify as a real estate professional, maybe your spouse can. And if you file a joint tax return, then both of you will qualify for the real estate professional status.
Right. So let's take a pause here a little bit. Let's just go back and, just kind of reiterate what you just said.
Yeah.
So the qualified real estate professional, as we call it, QREP, right? So if you have heard about that term, this is what it means, that, you or your spouse, if you can get that designation, that's an IRS designation, QREP. And in that case, if you have a passive loss on your commercial real estate property or any of these passive losses that you have, you can actually take that loss. So say, for example, if you invested 100K in a commercial real estate project, which, as we were discussing, would get you, say, for example, it gave you about 70% benefit. Again, that's a paper loss. That's not an actual loss. As Thomas was explaining, it's a phantom loss. So you say if you get that 70,000 in paper loss, and if you have 10,000 or 20,000 income and you were able to apply only 20,000 of that as a passive loss in the current year, now the 50,000 is left over, right? For you to able to take that and apply it on the active income of the spouse who's working W-2 job, either doctor, engineer, whatever profession that is, right?
Right.
If the other spouse qualifies for that QREP designation, now you can take that 50,000, and if you have, say, 200K income, you can apply that on it, reduce the AGI, and then that reduces your tax liability significantly, because now that's the higher tax bracket. So that's really that 40-50%, including the state taxes, that's getting impacted, which is a huge impact. So thank you so much for bringing this in, Thomas. Let's dwell a little bit deeper on that, because there are many of the investors, their spouse is not working, and in fact they're actually dealing with real estate, but most of the times they just don't know what it takes, right, to be a QREP. So let's talk about that. If a family and husband and wife, they are into real estate, what kind of activities can qualify them? So I understand there is a 720 hours requirement, and more than 50% of any job that you're doing, it must be mostly in the real estate, right? And then there is a material participation requirement as well, right? So let's talk about some examples of how these families can qualify for that designation.
Yeah. So basically, I'll give a few different scenarios that I've seen work well. So the 750 hours, let's assume one spouse is working part-time or perhaps not working at all outside of real estate. So let's just assume that 50% of your total working time is irrelevant here. And in my experience, it's often the case. So the question is, how do you get to 750 hours, right? One way to do that is by acquiring rental properties and just managing your rental properties. So in other words, you're self-managing. You might have some people helping you out, but you are, for all intents and purposes, the property manager. And in some cases, with as little as one property, you can make the 750 hours. Now, if you're only going to have one property, the way I've seen this work is someone buys a property, usually local to them, so within driving distance, and they go and they're finding that property. It's usually distressed or not up to market conditions, and they're spending a lot of time either doing the renovations themselves or coordinating those renovations and making sure everything is going on to get those properties up to market standards. And then they're going to go ahead, rent it out afterwards, and be the property manager. And usually between the time spent on renovations and the time spent as the property manager, you can get to that 750 hours. Now, we've seen that happen before. Now, it becomes easier with more properties. So if you have more properties, the easier that becomes. So that's one path, going the pure rental path. And really, that's if you're going to have one property, you're going to probably need to have a lot of renovations on that property to get to that 750 hours.
Yeah, and then that may happen in the first year that you have renovations, but the subsequent years might not actually give you that designation, because what we are thinking about 14, 15 hours a week, approximately, that you need to be spending in that property. So one property, once you renovate it, you're not going to spend so much time into it.
Right. And that's what makes it so challenging to qualify. So this is where the next part comes in. So here's another strategy. So some people will work in another real property trader business in addition to their rentals. And very common example is going to be when we see somebody become a real estate agent or broker and begin to start, transacting deals for themselves as well as for others. That can help you get up to that 750 hours. So very common path we'll see. One spouse become a real estate agent. They'll go out, start selling houses, properties, whatever the case is. And then that will help them get to the 750 hours. Then they're just self-managing their properties after that. So that's another very viable path. And we've seen people do it fix and flipping, wholesaling, in very similar ways. We've seen some people do it property management too. Like they'll actually do third-party property management for other people. But I would say that jumping in as a flipper or wholesaler or an agent, probably the more popular ways to get that 750, and then it's just basically self-managing your portfolio from there.
Right.
I'm happy to dive into
So
that.
so even if it's a real estate agent, right, you need to have some kind of material participation, right? You just can't just sell it for just others, right? You need to have maybe some properties that you're buying and selling for your own portfolio as well, right? So that's kind of the tricky. How about a short-term rental? Because, that kind of needs a little bit more management.
Yeah, so that's a great question. And there's a totally separate kind of way to look at short-term rentals. So short-term rentals, according to several tax court cases, short-term rentals do not qualify for the real estate professional status. And there's some reasons for that, but that's kind of the way it's viewed. So for short-term rentals, if your property has an average stay of 7 days or less, then it's not a quote-unquote rental property anymore. And it's not passive by default. So you don't need to qualify as a real estate professional to turn these losses non-passive. What you have to do is you just have to materially participate. Now, there's 7 material participation tests, but 3 that are typically most relevant to owners of short-term rental properties. And that is you spend more than 500 hours on the property. The second one is you spend more than 100 hours and nobody else spends any more time than you do. For example, you spend 101 hours and somebody else spends 50, you met that test. The next one is you do substantially everything for that activity, meaning you're a one-person show, a one-person band. And so again, for short-term rentals, average stay of 7 days or less, and you meet one of those tests I just mentioned, well, now the losses are non-passive and can offset your W-2 and active business income, etc., without having to qualify as a real estate professional. So you don't need to work full-time in real estate to make this work. So we see a lot of people who are, who have full-time jobs, or perhaps both spouses have full-time jobs or businesses. They kind of opt for sometimes this strategy of acquiring short-term rentals as a tax-saving mechanism because you don't need to work full-time in that business.
And you can apply only the depreciation benefits of that short-term rental to the losses of that property, or can you apply actually the other losses coming from, for example, syndication or other areas to that short-term rental income as well?
Yeah, that's a great question. So typically not. Typically it would only be the losses from that specific property or your short-term rentals if you have more than one and you're meeting these tests, because short-term rentals, they basically, what that 7 day or less rule does is it moves it from a rental real estate into the business category. So it's treated more as a business.
Got it.
So yeah, that's kind of how that works.
Thank you so much for explaining. That was a little bit tedious, wasn't it?
No problem.
Thank you so much. So what are the other ways, for example, most of these investors, they want to invest into commercial real estate, right? So being in the part of commercial real estate, there are LPs in it. So how can they create some other portfolios to be qualified and continue participating into the commercial real estate properties?
To continue to qualify as a real estate professional. Really what we see there, the big way to do that is to continually qualify would be to run another business that is a rental real estate, that is a real property trader business, like being an agent, like actually becoming an agent, actually making that a business that you're running. That's one way we see it continually happening. The other way is just continue to build your portfolio, continue to buy properties, more properties, bigger properties that need the ongoing renovations and maintenance and what have you to be able to reach that 750 hours. So really, that's the two ways we see people sustainably do it. Either just
Right.
continually acquiring rental properties year over year over year, and they're able to get to 750, and or they're working as an agent or a flipper or something on a regular basis year over year that's helping them get and maintain that status. It's kind of the two
Yeah.
major ways I see it happening.
No, that's helpful. And I do want to clarify though that, just being a real estate agent will not qualify you for the qualified real estate agent, right? That's not what we are talking about here. We are talking about that material participation and that 750 hours. So let's keep that in mind, right? So
Yeah.
again, this is just an education and information purpose only. If you want to get involved into this and you want a QREP designation, Thomas is a good resource, or anybody else that you think, but the CPA to guide you through this. That's really helpful. So please keep that in mind. So given that, what kind of tracking is needed for that 750 hours? Do you have, any templates typically are available? How do they track that, okay, yeah, I did spend 750 plus hours this year?
Yeah, absolutely. Typically, according to the IRS, according to the tax code itself, it says that or the regulations rather, that you could prove you materially participated by quote unquote any reasonable means, which can mean calendars, it can mean time logs, it can mean appointment books, it can mean all different types of ways you could potentially do it. However, what we've seen through audits and through tax court cases is typically the best way to substantiate your time is going to be through having a time log.
Okay.
Like a time log. And one way to do that is an Excel spreadsheet. It could be very straightforward. You have the date, the amount of hours you spent, the activity you did, like fix the toilet, for example, and then the property that it was associated with. And that could be just a log, and that could be good, right? Other people will use time tracking software, and there's a lot of different software out there that can do it. QuickBooks has a time tracking software. Toggle is another popular software, and there's others. But having a time log is probably the most credible. At least that's what it appears based on the tax court cases. And then how you go about using that time log, like again, it could be very simple, like a spreadsheet or an application that you could track your time.
Yeah, that's really helpful because the time tracking is really important. And yeah, there are so many software apps, which are some of them are free as well. It's a good time management to use as a time management as well. Just helps me understand where am I spending my time, right? That's really helpful. Do you have any templates or something that you could share with the audience probably so that they can learn from it?
Yeah, we have a time tracking spreadsheet. I don't know where it is right now, but I'll tell you right now, I'll put it up there for this.
That's great. Maybe you can send it to me and I can just link it in the show notes. So this is great, great conversation. Thank you so much for sharing all of this. So with that, the CPA and tax discussion can go on forever. But unfortunately, we do have to, come to the conclusion of this podcast and go into our next segment, which is one of my favorite segment, Thomas. So thank you so much again for this conversation. My next segment is called Think Outside the Stocks. And I, love to ask my guests that, in terms of diversification, in terms of putting those right tools and techniques in place, in terms of the investment opportunities, or even like estate planning or, things like that. I'd like to ask Thomas, how do you personally in your strategies think outside the stocks?
Yeah, absolutely. I'm a big believer in alternative investments. So I tend to make a lot of investments as a limited partner into syndicates and funds that are investing in multifamily real estate and industrial real estate predominantly right now. So that's one way I diversify outside of stocks. And then also I made an investment recently that was kind of an interesting investment for me. I invested in an ATM machine fund, which also has depreciation and all the good stuff we talked about today.
Absolutely.
But what that does is every month I get a deposit into my bank account. And I made that investment because it pays roughly an 11% return, give or take. And I'm going to use it to finance a car. So rather than going out and taking cash and buying a car in cash, I'm going to go get a loan on the car. The loan's going to actually be lower than 11%. So I'll make a nice little spread. And now that car is going to get paid off by the ATM machine. So
Absolutely.
that's one way.
Yeah, absolutely. I love that. And in fact, think outside the stocks, we have a diversified fund, and in our fund, we do have the ATM investment, which is, a little bit higher cash flow than what you explained here. But that's exactly how I'm using. And in fact, I practice infinite banking. So in addition to what I have done, similar to in your case, what you have done, I have, put the money into the infinite banking system, which is compounding tax free. Taken a leverage from there, put it into use for my daughter's education, because now she's taking the education loan, which is a little bit smaller. And again, take that money from the infinite banking and put it into the ATM investments, which is giving over 20% cash on cash. And that's, creating that money in my bank account every month, which is helping to pay these loans. In addition to these loans, once it's crossed over, there's going to be some extra that's going to come out. So I love that thought that you actually harnessed your expenses. And that's my theory, that, think outside the box, that harness your expenses, the expenses can grow too. So I love that. Thank you for sharing. It kind of reiterates my philosophy as well. So with that, we are kind of coming to the last segment where I asked a few fun questions,
Okay.
and just quick answers to that. So are you ready for that? I call it a rapid fire round.
I'm ready to go.
Absolutely. So Thomas, the first question I'm going to ask, that what is the most memorable and fun vacation that you have taken so far?
Most memorable and fun vacation. That's crazy. That's a good question. I'd say Las Vegas last year. And last year I went to Las Vegas for 7 days. And I'll tell you that going to Las Vegas for 7 days is a little too long. But between the shows and the excursions, like we did a lot of different crazy things.
Whoa.
It was fun. It was fun. It was the most memorable vacation that I had. And I just
So
got back from LA. So
So was it either you lost too much money or you gained too much money? What makes it memorable?
I actually didn't gamble that much.
Oh, that's good for you.
It was the shows, it was the weather. So it was like, it was cold here
Mm,
in New York where I live at the time, but it was
yeah.
like beautiful. There was like 100-degree weather, and it was very like, it is not humid there. So the
Mm-hmm.
weather was just awesome. We went and did multiple shows, which were great shows, like the Beatles show. We went, ATVing in the desert. We
Wow.
did gamble a little bit, but it was just the overall experience of Vegas, everything there is to do. It's just amazing. I just love it.
The life is full of experiences, right? It's not about money and
Right.
gains and losses, but it's about experiences, what we collect over the period of time. So thank you for sharing that. What is the outrageous amount or percent taxes that you have saved to one of the clients, and they were like, after they came to you in that year, that you implemented the tax strategies? And just a crazy story kind of a way.
Heck yeah. So, I mean, there was a few clients that we had that were high income earners. And I know one of them, this is when 100% bonus depreciation was in full effect. And this was before a rule called the excess business loss limitations prevented this from happening. But I think they ended up saving like $200,000 in taxes because they were buying big multifamily properties and they were just using bonus depreciation and they qualified for the real estate professional status, and they were able to use it to offset their W-2 income, which was quite significant. So 200K, I think, is the largest I've seen on paper, or at
Wow.
least that I remember. And then we've seen other clients like doctors and dentists and stuff. They're routinely saving $100,000, $130,000, $150,000 in taxes using reps or the short-term rental loophole, which we talked about before. And those are kind of the crazy stories. Now, one more story I'll share is I seen this one client have to pay almost a 7-figure tax liability. So
Wow.
because they had a property that was trapped in an S corporation, and they had to restructure it. I forgot the exact reason why they needed to pull the property out, but when you pull a property out of an S corporation, it's treated like a sale. So as if you sold it to somebody else, and you're gonna
Oh,
have
so there is
capital
no
gains.
basis or anything.
Yeah.
Uh-huh.
This property was put in the S corporation back in the 90s, and
Wow, that's crazy.
it appreciated significantly. So there's a very big tax bill, and that was a wild story. We tried everything to get it out tax efficiently, but there's only so much you could do.
Wow. Thank you so much for sharing that. Yeah, that's pretty wild. Capital gain versus the actual income, right? So that could be significant change. So thank you so much. So with that, how do the audience get in touch with you if they need to reach out?
Yeah. So yeah, I'm on Twitter at Thomas Castelli _, but really the best way to get in touch with me is I have a page that has all my links, all the ways to get in touch. It's thomascastelli.com/links. If you go there, I have my social links. I have my contact. You request a consultation. That's probably the best way.
Thank you so much for sharing. And thank you so much for this conversation again. I'm so grateful to have you on my show. Thank you so much for your availability.
Thanks for having me.
Yeah, and thank you. And listeners, go back and look at all these strategies, the tax benefits, especially the W-2 earners. How can you implement different strategies, utilize for different capital gains that you have from real estate transactions? Or if you plan to take a notch up and want to qualify for that QRIP, there is a ton of bits and pieces on how you can qualify for that. And if you want to get in touch with your CPA or Thomas, feel free to do that. Again, thank you so much for listening and keeping the Think Outside the Stocks podcast going. It is because of you. We are so grateful to have your support. Thank you so much, Thomas, again for coming on this show. And thank you so much, everyone, for listening.
Thanks again.
Thanks for tuning in to the Think Outside the Stocks podcast. If you enjoyed today's episode, please like and subscribe. Madhvi is on a mission to change the financial trajectory of one family at a time with 1,000 more to go. We hope you'll be a part of this vision. Please join our growing community, and to get your journey started, visit thinkoutsidethestocks.com to download your free guide on active income with passive real estate investments. If you learned something new, please share it with one person today. And if you have 60 seconds, please leave us an Apple review to help us reach more people like you. Tune in for the next episode.